Last week, people asked me, how do you take a loan out on crypto? I thought this would be the most practical way to do so. I wanted to do 7 steps to buying a house with crypto. Remember, you don't have to sell your crypto. With a crypto-backed mortgage, you can use your Bitcoin or Ethereum as collateral instead of cash. You get to keep your crypto, you get a loan in regular money, and you can buy a house. So there's platforms like Nexo, Salt, they make this possible. These companies will let you lock your crypto and get a home loan. Each has different rules, interest rates, and supported coins. So be careful you jump in. It's fast. Each coin has a different interest rate. Each coin is different, so you have to be careful. It's fast. You can skip credit score stuff. Approval is quicker than traditional loans. Sometimes happening in hours, maybe sometime instantly. Many lenders focus on the crypto value. They don't even look at the credit score, because once you give them the crypto, now they have a loan that's backed by collateral. That's how the rich get loans. People don't realize this, but they get collateral-backed loans. That's why they get them so easy and so quickly. And then they use your credit to see how much leverage you can get on that loan. So you still own your crypto. So if the crypto continues to go up, you still make money off of that. As long as you make payments, your coin is safe. But if the market crashes, your crypto goes in value, you may have to add more. That's a margin call. For example, if I got $50,000 in crypto and I say, hey, I want to take out a loan. So I send my money to Salt. It gives me, let's say, 2/3 of that. That's what's called a loan to value ratio, LVR. I say I got a $100,000 loan. I give it to Salt. Now I want to get a 2 to 3, let's say a 70% loan to value ratio. That means they give me $70,000. So now the rule of that is that if crypto falls, that $100,000 of crypto falls to $70,000 value, I got to put in more crypto. They're going to do what's called liquidate me. That means they have to sell that crypto to cover my loan. I give them $100,000 in crypto. I take $70,000 in cash, put it in my pocket. I use that for something else. The agreement is that if it keeps going up, you're okay. Just keep making payments. If it goes down to 70, you got 2 choices. We're going to liquidate you. You don't really have a choice in that. Or you can add more crypto to make sure, we're safe. So that's why you never you never take a loan out on all your crypto, because if that situation happens, they're going to liquidate, which means they force sell it. They cover the loan and they close out the loan. So you don't owe them nothing, but also you lost your crypto. That's the risk of doing that. It's called a margin call. You also avoid capital gains when you do this, because you never sold your crypto. You're taking out a loan. Because you're borrowing against your crypto instead of selling it, you skip capital gains taxes that can save you a lot depending on where you live. Blockchain makes all of this transparent. The loans are often they're based on smart contracts, fewer middlemen, they're cheaper, less paperwork, faster approvals. Now, crypto is volatile. If your coin price crashes, your loan could collapse, just like we talked about. And rules are different in every country. I just talked about the US-based rules. So make sure you check the legal side of your own country or where you're at. I think New York has different rules too before you sign anything. Now, I've done this before and it's been very fruitful. And I just think that it's a great option for people who really want to keep their crypto, but also access some of that value and maybe invest in something else. If you want to invest in something else that's going to be an income-producing asset, then it's a good choice. Let's say, for example, you got $500,000 in crypto, and you say, well, I'm going to take $300,000 a loan, I'm going to invest in an Airbnb or something like that. So you buy Airbnb and you start making profit on that. So now your crypto now you got enough leeway in there because you only took $300,000 out of the 500, so that if it's not going to fall that much, more than likely. So you make money off the Airbnb, you also get depreciation of that property, and you also get depreciation of Bitcoin. That's how the rich people move. That's how the wealthy, the rich, and the biggest people in the world move. And that's what I was talking about. Somebody that worked for me before, soon as he got his money, he bought 3 Rolexes, a boat, a Tesla. You don't do that. That's idiotic. And that's why people get stuck in these ruts for their entire life. You always look to buy assets first. Something that's going to produce money for you. A house, a business. And like I say, there's hundreds of businesses on Flipper. There's hundreds of businesses on Empire Flippers. There's other websites out there in which you can have $10,000, $20,000. You buy a website that's making $1,000 a month. You pay $20,000. You buy a website that's making $1,500 a month. And you got to remember, if you took out a loan to do that on cryptocurrency, you can pay off the loan with the profits. And then after, let's say, 15 months of that, or that's roughly what it takes to pay it off, 14, 15 months, maybe less, but $1,500 a month, it would take you roughly 15 months to pay it off. The 16th month, you're 100% profit. And you also have the value of the company you can sell to somebody else later. You can buy a business, so I've done this before, improve it and sell it again to somebody else on the same platform you bought it from. Some of these businesses run on their own. Some of these businesses are just websites with content. Some of these businesses are just drop shippers. Somebody's built up a business, makes $12,000 a month, $1,200 a month, maybe $3,000 a month. They sell it for $40,000. You buy it with a loan. Makes a lot more sense with a loan. And now you use the profits from the business itself to pay off the loan. And then once the loan is paid off, you own the company. You still got your assets you took the loan off of. And now you're making a profit on both. And then you do that all again and again. That's how you compound your money. That's why you cannot, the first money you make is what I call your breeding stock. And I'm a country boy. I'm from the country, Tennessee. But farmers, a lot of times back in traditional Tennessee culture, is that when you were married, your father would give you breeding stock, or your mother or somebody at the wedding would give you a cow, a bull and a woman cow, a female cow. And that's your breeding stock. It's up to you to make that into 50, 100 cows, or it could be goats or whatever. Now, if you're so stupid that you take the 2 cows, you cut them up and have a feast, yeah, you're going to have man, I'm telling you, that feast will be amazing. The whole city will be there cheering you on. You'll look like a well-to-do person for that weekend. Have a barbecue with 2 whole cows that'll feed 1,000 people. But after that's done, you have no breeding stock.